The official closing price for Tilray Brands as of Friday, January 23, 2026, was $9.05 per share, representing a modest decline of 0.87% for the day on a volume of roughly 2.7 million shares. As today is Saturday, January 24, 2026, the market is currently closed, and this figure reflects the final standing of the stock heading into the weekend. While many investors are obsessively tracking every minor update on potential federal reclassification of cannabis, the most surprising data point currently being overlooked is Tilray's massive expansion into the craft beer market. Most people still view this as a pure-play marijuana stock, but Tilray has quietly positioned itself as the fifth largest craft brewer in the United States. This pivot isn't just a side project, it is a calculated infrastructure play. By acquiring a massive portfolio of beer brands, they have secured a ready-made distribution network across the country. The reality is that if and when federal regulations shift, Tilray won't be starting from scratch trying to find shelf space. They will simply be swapping or adding products to a logistics chain that is already operational and profitable. I want to pause here and ask for your perspective on this strategy. Comment how many shares you currently hold and whether you bought in for the cannabis potential or if the beer and wellness diversification has changed your thesis. Looking at the technical side of the recent daily and weekly price swings, the stock has been under some pressure lately. On January 22, the shares dropped about 7.4% following an analyst downgrade that questioned the sustainability of the recent rally. This hides a persistent tension. While the fundamentals are improving, the valuation remains sensitive to institutional sentiment. Trading volume has also seen some interesting shifts. While the average volume sits around 5.7 million shares, we've seen spikes as high as 16 million during heavy news days. This suggests that while long-term conviction is building, there is still a massive amount of fast liquidity that enters and exits the stock based on headlines. Institutional positioning reflects this as well. We see major names like Vanguard, BlackRock, and State Street maintaining or slightly adjusting their positions, while firms like Susquehanna and Millennium Management have been more active in their trading, likely playing the volatility. The short-selling landscape for Tilray is something every holder needs to monitor closely. Currently, there is notable short pressure with approximately 98.6 million shares sold short, representing about 8.86% of the float. The short interest recently decreased by nearly 2%, which suggests some bears might be losing confidence after the surprise profit report. With a days-to-cover ratio of about 2.4, there is enough pressure to create a squeeze if a major positive catalyst hits, but it's not at the extreme levels we've seen in the past. Notable short reports often focus on the company's past reliance on acquisitions rather than organic growth, arguing that the revenue figures are bought rather than earned. The short thesis generally revolves around the idea that the cannabis market remains too saturated and that Tilray's international expansion, while ambitious, is capital-intensive and risky.
Countering that short thesis is the fact that Tilray's debt management has been aggressive. They recently reduced their outstanding debt by $7.7 million, bringing their net debt to EBITDA ratio down significantly. For retail investors, interpreting this data requires a balanced view. A high borrow rate or a sudden spike in fail-to-deliver data can signal that shorts are trapped, but chasing a squeeze is incredibly risky because those same metrics can reverse in a single afternoon. If you see the borrow rate climbing above double digits, it's a sign that the cost to maintain a bearish position is becoming prohibitive, which can lead to forced covering. However, investors should look for fundamental strength to sustain a move rather than just hoping for a technical squeeze. Tilray's business model is now built on 4 pillars: cannabis, beverages, wellness, and distribution. Their wellness segment, including hemp-based foods, is a steady revenue generator that often gets overshadowed by the more exciting cannabis news. Their international medical cannabis footprint is perhaps their strongest long-term moat. By rebranding their Italian unit and expanding EU GMP-certified products, they are dominating the European medical market, which has much higher barriers to entry and better margins than the Canadian retail market. The Canadian market itself remains a challenge due to heavy taxation and oversupply, which is why Tilray has been so focused on diversifying outside of it. Retail sentiment on platforms like Reddit and X remains highly polarized. There are vocal groups calling for more transparency regarding institutional shorting, and others who are frustrated with the slow pace of U.S. reform. It is important to remember that while retail investors can create massive social media momentum, they cannot easily influence federal policy or institutional capital flows in the long term. The debates often center on whether the CEO, Irwin Simon, is a visionary building a global empire or a manager who overpromises. What's clear is that the company is no longer just waiting for permission to exist. They are building a business that can survive even if the U.S. federal government remains stagnant for another 2 years. Looking forward, there are several possible scenarios for the remainder of 2026. If the U.S. finalizes the move to Schedule 3, it will likely result in a massive tax windfall for cannabis companies by removing the burden of Section 280E, which currently prevents them from deducting normal business expenses. This would be a game-changing boost to Tilray's cash flow. However, the risk remains that political gridlock or legal challenges could delay this indefinitely. Another potential catalyst is the continued growth of their beverage business. If Tilray can successfully integrate their latest acquisitions and show significant margin expansion in their beer and spirit segment, they could be revalued by the market as a mainstream consumer staples company, which typically commands much higher multiples than cannabis stocks. As we wrap up this analysis, it is clear that the expectations for Tilray are often at odds with the current reality. The expectation is a volatile weed stock that lives and dies by the stroke of a politician's pen. The reality is a diversified global company with record revenue, a strengthening balance sheet, and a massive physical distribution network in the U.S. The recent price dip following the analyst downgrade may be a reflection of short-term skepticism, but the move toward profitability cannot be ignored. Investors need to decide if they are betting on a legislative miracle or on the management's ability to continue building a diversified consumer powerhouse. What's your take on the rising short interest? Do you think the short thesis that organic growth is lacking holds up, or is it overstated given the massive revenue numbers we just saw? Tilray has effectively used its stock as a currency to build a global platform that most competitors simply cannot match. While this has led to dilution in the past, the resulting infrastructure is now generating actual profit. This is the core of the expectation versus reality framework. The market still prices Tilray for its potential in a legalized world, but the underlying business is starting to prove it can stand on its own feet in the current one. The path forward will likely be characterized by continued volatility, especially as we approach the estimated April earnings date. Clear heads will prevail by focusing on the cash flow and the integration of these non-cannabis assets, which provide the safety net that pure-play competitors lack.
In summary, the key insights from this week's action show a company that is bloodied but defiant against a difficult regulatory backdrop. The surprise profit from earlier in the fiscal year remains the most important fundamental anchor, even as short-term traders focus on the 7% dip from the analyst downgrade. The high-volume days show that there is still significant interest in the stock, and the institutional ownership levels suggest that the big players are watching the transition into the beverage market very closely. Whether you are a long-term bull or a skeptical bear, the data indicates that Tilray is no longer the same company it was 3 years ago. The shift from a speculative startup to a complex multinational consumer goods firm is nearly complete. As we head into the next quarter, keep a close eye on the borrow rates and the revenue growth in the non-cannabis segments. Those will be the true indicators of Tilray's health, regardless of what happens in the halls of government. Stay grounded, watch the volume patterns, and don't let the headlines distract you from the numbers on the balance sheet. Would you like me to look into a specific competitor's short interest for comparison?